Welcome back to the Deep Dive. We are TalkTickers, and today we're digging into the first quarter 2025 earnings call from JOYY Inc.
That's right. We've sifted through the results, the management comments, everything they put out.
And our goal here is simple. Cut through the jargon and give you the key takeaways, what really matters from this latest update.
Exactly. This call shows a company, well, really in the middle of a pretty big strategic change. We'll hit the main numbers first, then dive into the why and how behind their strategy.
Okay, let's start with those headline results for Q1 2025. Total net revenues, they landed at $494.4 million.
Yep, and that was right at the higher end of their own guidance. So a solid start on the top line.
And profit-wise?
Even better, actually. The non-GAAP operating profit came in at $31 million. That was definitely ahead of what the market was looking for.
Okay, and here's where it gets interesting, connecting to that strategic shift you mentioned. Non-live streaming revenue.
Right, that hit $123 million.
Which is a 25.3% jump compared to last year? That's significant.
It really is. And maybe more importantly, look at what that means for the overall business mix. That non-live streaming slice is now almost 25% of their total revenue.
Wow, 24.9%, up from just, 13.4% last year?
Exactly. That's not a small tweak. That signals a real transition happening in where their money is coming from.
Definitely shows they're serious about building up those other areas.
Yeah.
And the underlying financials, still looking stable.
Very much so. Strong operating cash flow. They generated about $58 million in cash just from operations in the quarter.
And they ended the period with a hefty cash pile too, right?
Yeah, a net cash position of $3.4 billion. Gives them a lot of cushion, a lot of flexibility.
Okay, so the snapshot is strong revenue, beat on profit, huge growth in non-live streaming changing the mix, and a solid cash base.
That sums it up nicely. So ready to peel back the onion a bit.
Let's do it. Let's break down those numbers segment by segment.
Okay. So the traditional live streaming part brought in $351.3 million this quarter.
Which means, as we said, the real growth driver was the non-live side.
Absolutely. And within that, Bigo's non-live revenue, which they clarified, is mostly advertising. They grew 27.3% year over year. Came in at $80.3 million.
That's some serious acceleration for Bigo's. What about the other non-live segments?
Also showing good growth. Those other segments' non-live revenues were up 21.6% year over year, reaching $43.2 million.
So broad-based growth in non-live, not just one area.
Precisely.
Now, margins. A shift like this in revenue mix often impacts profitability. What did the gross profit look like?
Group gross profit was $178.6 million. That works out to a gross margin of 36.9%.
And how did that play out between Bigo's and the other segments?
Well, Bigo's gross margin was pretty stable. But the other segments, that's where things got interesting. Their gross margin jumped significantly.
How significant?
By 9.8 percentage points compared to last year, at 41.7%.
Almost 10 points. Wow. What's driving that improvement there?
Management pointed directly to getting better monetization from that growing non-live streaming revenue in those segments. So they're not just growing the top line there, they're doing it much more profitably.
Right. So that shift isn't just cosmetic, it's boosting the actual profit per dollar in those areas. And speaking of profit, let's talk costs. Operating expenses were $167.2 million.
Yeah, and what's notable is that's down from $195.4 million last year.
Down. How do they manage that while growing the non-live side?
Good question. It reflects some deliberate choices. They mentioned optimizing sales and marketing spend, particularly for the live streaming business, kind of focusing more on efficient spending, ROI, not just growth for growth's sake.
Getting smarter about acquiring those live streaming users, basically.
Exactly. And importantly, even though the non-live business is growing fast, where you might expect costs to jump, they kept spending disciplined. Expenses there grew, sure, but slower than the revenue did.
Which suggests pretty good operating leverage. Costs aren't keeping pace with revenue growth.
That's the idea. Points to better operational efficiency overall.
Okay. And the bottom line, net income.
Non-GAAP net income attributable to the main shareholders was $63.2 million. That's a margin of 12.8%.
But management noted that was down year over year, didn't they?
They did, but they explained it wasn't really about the core operations. It was mainly due to, well, financial factors.
Like what?
Primarily lower interest income. Remember that huge cash balance? They paid off a convertible bond last year, so less debt, but also the interest rate environment in Q1 was just lower, so less income earned on their cash. It affects the final net income number, but not necessarily the health of the actual business operations.
Ah, okay. That's an important distinction. So the core message from management about the future.
They were really clear. They expect those non-live streaming businesses, advertising, and smart commerce to become the company's second growth engine. They see 2025 as a key year for really proving out this strategy, focusing on what they called value-adaptive organic growth.
Meaning growing where it's profitable?
Essentially, yes.
Yes. Okay, let's circle back to the original core business for a second, live streaming. They've been making changes there since late last year. What's the plan?
It's about optimization. Tuning the revenue sharing with streamers, refining how they acquire users, to really focus on high-quality paying users, especially in their core markets, developed countries, the Middle East, places where monetization is typically higher.
And they acknowledge this has caused some, let's say, bumps in the live streaming revenue recently.
Yes, they were upfront about that. Optimizing for profit and quality sometimes means shedding some lower value revenue in the short term. But they also said these changes have already significantly boosted the operating profit from Bigo Live, their main product.
So even if the top line is fluctuating, the profitability of that core business is improving. What's the outlook for live streaming revenue going forward? Do they expect it to keep dropping?
No, actually the opposite. They guided for live streaming revenue to likely stabilize starting in Q2 and then actually resume positive growth quarter over quarter.
Really? Quarter over quarter growth soon?
That's what they indicated. They sounded pretty positive, mentioning some encouraging data like seeing month-over-month growth return in some developed regions already, specifically mentioned North America, driven by more paying users and better retention.
Okay, so maybe those optimization efforts are starting to pay off in attracting and keeping the right kind of users. Did they talk about product changes?
They did. Things like redesigned VIP benefits, better gifting features aimed at the high-value users. They said these are having a positive effect on ARPPU, the average revenue per paying user, and keeping top streamers engaged.
Right. Okay, now back to that big growth story advertising, Bigo ads. That 27.3% growth is impressive. What do they say is driving that?
A few things. One, really focusing on what advertisers need, like placing ads across different channels and proving a high return on investment. Two, using their existing advertiser relationships from live streaming to help grow their publisher network.
And leveraging their user base, presumably.
Absolutely. They mentioned having around 260 million users across their platforms. That scale, combined with their own data, allows for really precise targeting. That's key for delivering the positive ROI advertisers want.
AI came up a lot too, didn't it?
Yes, very central to Bigo ads. They described using AI for basically the whole process, understanding users, helping create ads, targeting them precisely, and optimizing campaigns in real time.
So it's not just about having users, it's about intelligently connecting advertisers to the right ones.
Exactly. And they claim this improves things for advertisers and creates better monetization for their publishers, which then attracts more advertisers and more publishers. A positive feedback loop.
What also stood out was them saying Bigo ads is already profitable, adding to the bottom line now.
That's a crucial point. Often these new, fast-growing ventures burn cash for a while. But they attribute its profitability to leveraging their existing global infrastructure, their R&D teams, and optimized network costs. Basically, using what they already have makes it efficient to scale.
So it's not starting from scratch, cost-wise?
Right. And they think it's set to become a major profit driver down the line.
Okay, looking ahead. They gave guidance for Q2 revenues.
Yes, between $499 million and $590 million. They caveated it, preliminary views, market conditions, seasonal factors, standard stuff.
And the Q&A shed more light on the second half of the year.
It did. They reiterated confidence in live streaming, stabilizing, and growing QOQ. And for non-live streaming, they actually expect sequential growth to accelerate in the second half.
Accelerate? Why?
Primarily because advertising tends to have busier seasons in the second half of the year. More spending usually happens then.
Makes sense. And costs and margins for the full year? Any outlook there?
They pointed to the improvements already seen in Q1, the better Bigo operating margin, that big jump in the other segment's gross margin. They expect that trend of improving group non-GAAP operating profit to continue through 2025, and specifically mentioned expecting a meaningful reduction in the operating loss from those other segments compared to last year.
Okay, so pulling it all together, this call really paints a picture of a company in transition, actively managing that shift.
Definitely. Moving away from just relying on live streaming, building up that advertising engine and other non-live businesses.
And that growth in non-live isn't just potential, it's happening now, and it's profitable. It could really change how the market sees the company.
At the same time, they're working on making the core live streaming business more efficient and profitable, even if the top line isn't exploding right now.
Plus, that strong balance sheet, the $3.4 billion in net cash, and the fact they're still returning cash to shareholders through dividends and buybacks.
Yeah, $49.1 million in dividends, $22.5 million in buybacks just in Q1. That shows confidence and provides stability.
So for you, listening to this, understanding these moving parts, the growing non-live side, the optimizing core is really crucial for figuring out their future potential.
It's about seeing how they navigate this dynamic online entertainment and ad market.
All right, it's time for our favorite segment. This is not financial advice. Let's put on our purely speculative hedge fund wannabe hats for a moment.
Okay, strictly a thought experiment here, based only on the story management told on the call.
Given all the talk about accelerating profitable non-live growth, especially Bigo ads driven by AI, scale, cost advantages,
You could, hypothetically, build a long thesis around the idea that the market isn't fully appreciating this shift yet, that it still sees JOYY mainly as a live streaming company.
and the argument would be that as this profitable Bigo ads engine keeps scaling, maybe combined with that smart commerce they mentioned, it could force the market to revalue the whole company more like an ad tech or platform player over, say, the next 18-24 months.
Right, a potential re-rating based on the changing business mix and profit drivers. So the hypothetical trade is going long based on that narrative playing out.
Now, just for fun, how might you theoretically hedge or amplify that? Again, purely based on the call's narrative.
Well, you might look for, again, hypothetically, another global online platform that seems to lack the specific advantages JOYY highlighted. Maybe one less advanced in AI targeting, or without the same cost-efficient global setup, or maybe not as strong in those specific emerging markets JOYY kept mentioning.
So a short position on a perceived laggard based only on the competitive advantages claimed by JOYY in this call.
Exactly. But let's stress this again. Highly speculative, purely based on the narrative of this one earnings call. Absolutely not financial advice. Do your own homework.
Definitely. It's just an exercise in thinking about market narratives and how they might shift.
Okay, so wrapping up our deep dive on JOYY Inc's Q1 2025.
What we heard was a company pushing forward with a strategic pivot. Strong growth in non-live streaming, especially advertising, boosting revenue and already showing profitability.
Meanwhile, the core live streaming business is being optimized. Revenue is a bit bumpy short term, but margins are improving and they expect stabilization and renewed growth there pretty soon.
And underpinning all this is a solid balance sheet and ongoing shareholder returns. It's a complex picture, but understanding the interplay between the growing parts and the optimizing core is key.
And remember, everything discussed today comes straight from the company's earnings call materials. It's their perspective.
None of it is financial advice. Always do your own research. Thanks for joining us for this deep dive.